Welcome to Public Affairs Roundtable, a discussion of current events in the nation and around the world and how they affect the people of Indiana. Here's your moderator, Larry Lough.
Tax reform. At long last we have tax reform, or at least some proposed changes in tax policy that we're calling tax reform. Today on Public Affairs Roundtable we'll address some of the questions regarding this bill and how it's going to affect you and me. Our panelists today are Neil Palumba, who is Dean of the College of Business at Ball State University, Howard Hammer from the university's Department of Finance, and John Rouse from the Political Science faculty at Ball State. Neil, is this reason to celebrate, or is the jury still out on what we have here in terms of this bill?
I think we have reason to maybe celebrate, and definitely the jury is out. This is extremely complex, maybe the most elaborate change in our tax system in the last, I don't know how long, and certainly in my lifetime. And I think, as an economist, I would say that the clearest answer that's emerging from the murky lake of tax reform is that this is a genuine attempt for the first time in many, many years to move our whole tax system radically towards more economic efficiency. That is, basically spread the base, lower the rates, get rid of a lot of decisions that are made strictly for tax purposes, and put emphasis on making decisions for economic efficiency purposes. A company makes an investment because it's good economic sense, good business sense, not because they're going to get more tax dollars back than their expenditure. For a state like Indiana, in the long run, if what I'm saying is true, and I hope it is, then for a state like Indiana, that's pretty good news. But in the short run, you've got this very complex change. We're not quite sure what it means, and some of our big industries, heavy industries that have been somewhat favored with their tax write-offs in our old tax system, are going to lose for a while. And although in the long run that means more economic growth, in the short run a state like Indiana might actually lose a little ground as steel industries and auto industries get a temporary setback.
What have we done, Howard, in this bill? What indeed does it do? Does it, you know, as Neil says, we don't get a whole lot more money that we know? Are we simplifying it, the tax system? What does this bill do?
Well, I think the principal surface changes are that we've reduced from a large number of tax brackets and a high maximum tax, the highest tax rate of 50%. Those highest rates are reduced, and the number of tax brackets are reduced to effectively 3 or 4, depending on how you look at it. There are 2 quoted rates. There's a surtax on top of that, and then the high income gainers then on the last dollars don't pay the surtax. So it is a simpler system in the sense of fewer rate brackets and a lower tax rate. You also have a shift of the taxes from individuals to businesses. There's something like, over a 5-year period, a $21 billion shift, taking $21 billion in tax liability from personal taxpayers and shifting that to corporate taxpayers. So those are significant changes, and they're going to have a lot of impact. The other changes, you go down a long laundry list of tax deductions, exclusions, which are now no longer part of the tax code. And I think that's what Neil was talking about when he talked about businesses no longer looking at the tax code and deciding what to invest in, but looking at business circumstances and making their decision there. Because no longer is it more sensible, it's less sensible now to invest in certain kinds of activities just because the tax code exists.
John Rouse, we're talking about tax reform, but what we have here basically is just a bill that's come out of a committee that the committee's agreed on as part of the political process. There's still going to be some attempts to amend it on the floor, so the political process of putting this conglomerate bill together is a long way from over, is it not?
Well, I think things are pretty well set. There are not going to be very many changes. I think what this bill does, the whole issue of tax reform, is to focus upon, after all, what is politics, and that is simply is who gets what, when, and how. something else we could look at in terms of the politics. If the politics are not set, and certainly they're not certain right now, for support of this tax measure in terms of the IRS and people paying their taxes, because what we have here is a voluntary system in America, a voluntary system where people declare what they should pay. So if it doesn't have that kind of political support over time, it perhaps is not going to be successful.
Some of the voluntarism is taken out, though, by the federal government. I mean, you get your W-2 from your employer who also reports to the government, so it's not you pay what you want, you declare and we trust you. I mean, there are a lot of checks and balances in that system, aren't there?
Well, I think the phrase you mentioned is the issue of we trust you. I think there is a great deal of flexibility in the system as to how people interpret what they owe. I still think it comes down to the American people. The political system is based upon the willing participation of those who support the system. And over time, if there is not support for this program, there's going to be a political problem.
Are we taking some of this trust out of here? I mean, if we limit the number of deductions, if we, in fact, cut back on some of these deductions, is the government, in fact, tightening up here a bit?
I would think, and it's so difficult to analyze this very complex piece of legislation quickly, but I would think the new system on this one measure of trust or compliance moves us a little bit closer to honest compliance, or maybe honest is a bad word, to a compliance where more of us agree. Because for those of us who earn a salary that has a W-2, really the interpretation again comes in things like, do I income average, and do I, which deductions can I take, and can I take this magazine deduction or that, or can I take this expenditure? And those questions still remain, but there are less of them. And for many Americans at the lower end of the scale, they're being wiped off the tax rate roll, so I think they'll feel better somewhat about others having deductions because they feel that they've gotten something too. With a lower tax rate and higher deductions, higher dependent deductions, there'll be a few people at the margin says, I don't want to fool around with these deductions. I can't take my sales tax anymore, and I mean, if I own a house, I want to take that mortgage interest. But if I'm renting, all of a sudden, more and more, I don't have an estimate myself, but I think a larger number of Americans will suddenly find out, hey, I mean, I can't even go to a tax preparer and take their full deduction anymore. I have to put that deduction along with any other legitimate deduction against my 2% of gross. I lose that first 2% of gross deductions. So I think I'm trying to say is that for many Americans, they will simply look at the system and say, okay, I don't know if it's real fair, but it's fairer, and I'll just, and I won't fool around with some deductions, and I'll just pay my tax.
If you wanted to look at the rate issue, now the incentive is with a 50% tax rate. If you declare $1 of income and you could somehow avoid declaring that, it costs you 50 cents. If the highest tax rate is 28% for most taxpayers, then it only costs 28 cents, so to speak, to declare that. And that may, in fact, be the kind of incentive for reducing the number of underground transactions, for going to the trouble of producing a questionable employee business expenses or other kinds of expenses which were deductible fully under the old code. So I think on the issue of compliance, this bill is generally a plus.
That's an excellent point, Howard, because any individual who, when you're facing a 50-cent saving on $1, you may say, well, you're not, okay, let's rule out those who say I'll do something dishonest. And you'll say, well, I'll take a question, I'll take a chance, and then if I'm audited, I got the problems and the expense of going and explaining in detail what I did and maybe losing. Now suddenly I got to do all that for 28 cents. I might still do it, but more and more of us will say, for 28 cents, I'll declare the $1 and not play with it. Because there is something to be said for peace of mind. When you fill out that form, and if someone pays an extra $100 in taxes, not that they're throwing it away, but because they didn't cut some corners, they're not just losing $100. They're losing $100, but they're gaining some peace of mind. And for each of us, that's going to be a different rate. At 50 cents on the dollar, many of us will say, well, I'll take a chance. I'm going to question this system. For 28 cents on a dollar, some of us will still say that, but some others will say, hey, it's not worth my effort.
If I could follow up on the question, apparently there are 3 pillars of tax policy. Is the tax policy fair? Is the tax policy simple? And is the tax policy economically efficient? Could you fellows address the 3 issues on this problem? First of all, fairness.
Well, I was just going to, you were too quick. I was just going to say the only one I want to talk about is economic efficiency, because I don't know it's fair, and I do know that none of the systems that we have had or are going to have or have ever talked about are simple. So simplification, well, the way I use the word simple, I would just throw that out. Our current taxes aren't simple. Taxes 10 years ago weren't simple. Taxes 20 years from now probably won't be simple, at least not under what we see in the papers today. Fair, I really honestly don't know what is fair. And I'm not being facetious. I don't know what fair is. But I do know economic, well, we believe in economics, we know something about economic efficiency. And I really believe on that measure, the current proposal working its way through Congress, and that our president says he wants Congress to pass so he can sign, is definitely a movement towards for improved economic efficiency.
Now, when you talk about efficiency, are you talking about in collecting taxes that ought to be paid?
No, I'm sorry. I'm talking about economic efficiency, the effect of taxes on the economy, which is in a pure economic system, you don't want taxes because they mess up production decisions and consumption decisions. But you know you have to have some functions for government. They have to maintain order, courts, money supply. They have to maintain the military, space exploration, if that's what you're interested in. Certain things have to be centralized. And so what we want is a tax system that generates that revenue. Okay, and there is an efficiency question there, but that's not the one I'm talking about. But we want it to generate the revenue in such a way as to have the minimum damage on the economic decisions of the economy. And that's the economic efficiency I'm talking about. Of all the topics, and they're all good topics, but that's the easiest one for the economists to get a handle on, the only one we ever really get a handle on. And of that one, the current tax code is not perfect, but moves us closer to having a tax system that raises tax revenue and makes and doesn't interfere too much with the decisions of consumers and producers. So the economic efficiency that I'm talking about here, most economists talk about, is getting the most production out of our resources. How can we get the biggest GNP in the U.S. with our current resources and still raise some tax revenue for things like national defense, space exploration, aid to education. Let's not forget aid to education, since many of us here are employed by universities.
We deal in collections then. One of the basis for any tax reform, as we went into this, as we talked about this in a program several weeks ago, was that any program had to be revenue neutral.
Right.
Do we know that we were there with this proposal?
That's probably one of the most interesting parts of the debate, because at the last minute in the conference committee, the conference was shocked to find that there was some $17 billion of difference between what their expected forecast would bring and what actually they now forecasted. So they had to scurry around at the last minute, working out compromises and finding another $17 billion, which even by federal government standards is a pretty good amount of money. And what I think is interesting about this is that all these forecasts are based on what they call a static analysis. They assume more or less that people are going to do what they have been doing. And that seems to fly in the face of reason, because even now as you look at the papers, the public is getting advice on how to make last-minute changes in the 86 transactions in order to lower their tax bill. People are being advised to take deductions now, subscribe to professional journals this year, not next year, sell capital assets this year and be taxed under the capital gains treatment, which exists this year. Put off income till next year. So already I'm sure some of those assumptions that went into the revenue neutrality finding are not valid.
When will we know?
Well, we will know when the tax collector finishes his work in 1987 and 88. Just as the issue of GNP, what will be the effect of this bill on economic output? And some of the economists now have looked at their crystal balls and fired up their computers, and they've come up with, I think, a consensus that the effect on the economy in the next year will be somewhat negative. Perhaps a decline in GNP only due to tax purposes. And then in the future will be a plus. But again, that leaves out all kinds of things that can enter into it. We've seen how oil prices can affect the economy during this year. So I think there's a great unknown on the issue of revenue neutrality.
Larry, I think that I should try to address the issue of fairness, since that's basically a political question. The public opinion polls, first of all, say that most Americans think that the progressive or slightly progressive income tax system is not fair. But of course, if I asked students if they thought that tests were fair, they would say it was unfair to have tests. So in a sense, Americans might say we shouldn't be taxed at all. So in terms of our history, the focus is upon as few taxes as feasible. I think in terms of the fairness, this issue of tax reform has been one that has been in the political system in terms of, since when I can remember at least, 1976, when Jimmy Carter was running for president, he said that the tax code was one of the most unfair or atrocious things around. So I think that discussion perhaps began with that campaign in 1976, and that's now been 10 years ago. 1978, the Kemp-Roth focus and the Republicans took the issue. 1980, Ronald Reagan also focused upon the issue. So what we have now is a consensus for tax reform. A consensus not only from Republicans but also from Democrats. A consensus not only from corporations and their representatives but also individuals. So we have a consensus. So we have to ask, is it fair? Perhaps that's something that we don't know at this time.
Well, that's relative. I mean, we talk about the deductibility of the 2-martini lunch. I mean, that the average worker, Joe in the factory, might not see that as a terribly fair part of the tax code, whereas business might see that as part of the cost of doing business.
Well, you notice that as the debate went on these matters, the talk about reform to some extent became intermixed and obscured by the lower tax rates. I mean, most voters under this bill will have a lower tax rate. Whether or not they pay a lower tax may depend on some other things, like whether or not they were taking advantage of deductions previously. So I think this business of the tax rate has become has led to political popularity of the bill. And that's a very complicated issue because those in the middle income tax brackets, the $20,000 to $50,000 range, those are the people whose tax bill may either stay the same, go up, or be reduced under this bill, depending on how important the IRA deduction was to their tax return. So this whole issue of popularity and perception is one, again, that will be decided April 15th, perhaps, when people fill out the first tax form.
Let me put a different spin on this just for a moment and say that all of these are very important issues, and basically I think each of us are saying that we have some ideas of what's going to happen. We're not quite sure what revenue is going to be raised. We're not quite sure if the public is going to find this to be fair or not, and we're not quite sure of the full impact on GDP, although economists are saying in the long run it should be positive. And again, I'd like to emphasize for a state like Indiana, that is good news, but there is a short-run negative news. Not a horrible negative news, but a short. But the one thing I would appeal or like to throw out onto the table and say is, as a citizen of this country, I would like us to fairly soon stop tinkering with the tax system in a major way for a while. Because if we keep on changing the tax law every couple of years and discussing changing it in between, and we've been doing this now for several years, and if we're going to continue this, I'm not saying that the new tax system is perfect. I don't think anything is perfect. But even if it's a little bit bad, if we don't keep on changing every couple of years, we are going to run the risk of having a negative impact on investment decisions, because corporations will simply not have a real tremendous uncertainty. The worst thing I think you can give corporations, major corporations, when they go to invest is uncertainty. Life is uncertain to begin with. If we make it more uncertain by saying, here's a tax system, no, here it is, no, there it is, I'm going to change it tomorrow, maybe next year we'll raise the rates, maybe we'll lower them, maybe we'll raise them again, I think at some point it's going to hurt the economy. And so I think we have to go steady as we go sometime soon, I hope.
Well, I think that's a nice goal, but if we could control and make the politics stable, We could also make the economics stable, but as Howard alluded to, we don't know what the price of oil is going to be next year. And beyond that, we don't even know where the Iran-Iraq war is going to take us. I mean, what if Iran takes over Iraq? Saudi Arabia, whole kinds of things, all kinds of things. So if we could keep the politics stable, I'm sure we could keep the economics more stable.
It's said that when are these major changes in tax policy, tax code, the real winners are the accountants. Are we looking at that case again here? I mean, when I sit down to do my taxes next April or March or February, if I'm efficient, am I going to notice a difference, or am I going to have to take this to an accountant to explain it to me?
I'm not sure, but I think most of us are going to have to take it to an accountant. But it's a little different this time. This is just my opinion, is that in the past we've said the new taxes were, the only one who really gained were accountants, all accountants who did taxes. Now I think the answer might be accountants with very special practices, a lot of skills, CPAs, but who do this full-time and who deal primarily with middle income and above individuals and corporations. They should do well from this law, because again, we're going to have to go to them. However, there is a possibility that there's a small group of accountants, and they're probably not CPAs, and they're not as trained as accountants as some of these others, who deal with the lower income Americans and low middle income Americans tax preparations. They may lose for the first time because so many Americans are taken off at the low end of income are taken off the tax rolls, and another bunch, for them it is a simple situation. You put what you earned, you make a few other statements, and you can't deduct your fee. I don't want to mention names of companies. You can't deduct that fee anymore, and so for the first time we may have a tax law that's good for 2/3 of the accountants, but not good for that lower range of accountants. When I say lower range, I mean the range of accountants who are less, have less preparation and deal with lower income Americans, don't deal with major corporations or wealthy Americans.
In the short run, it appears that the accountants are going to do very well, because I think for a large number of taxpayers, those so-called middle-income taxpayers, $20,000 to $50,000 and a little above that, those people need to be making decisions right now concerning their taxes for this year. Just as an example, the loss of the sales tax deduction means that if somebody's contemplating buying a big-ticket item, a new automobile, it suddenly becomes much more desirable to make that purchase prior to January than it would be to wait, because the sales tax is going to be deductible this year. So there may be a whole series of decisions that need to be made now, and I think taxpayers know, at least in that income level, may be seeing their accountants twice. So.
From a political point of view, I think the Democrats win. Short term, in terms of this election process coming up in '86. On 2 points. The shift is from corporations to the individuals, and also those at the lower end of the spectrum pay less taxes. So this is a very more liberal Democrat kind of bill. However, the president, of course, sticks with this bill because, first of all, he wants a bill. Secondly, because he thinks that this bill will shift more taxes to state and local government. State and local people will rise up and say, we want less taxes, and so therefore he also wins. So from a short-term point of view, I would think that the Democrats have the edge in this process. But from a longer point of view, the president perhaps would say is that we're going to have less taxes because the people at the local level will say, we want less taxes.
Wouldn't it seem that Republicans in power now would feel some or receive some benefits short-term from this? In fact, that the Reagan administration is in charge, so to speak, in Washington. President Reagan will sign some tax reform bill, and there will at least be that perception that Republicans have helped engineer this tax reform.
Well, especially, for example, from Bob Packwood's point of view. He is up for re-election in Oregon, and he protected, for example, the timber business. And he shepherded this bill through the Senate. On the other hand, Dan Rostenkowski would like to be Speaker of the House of Representatives in a year or so. So in terms of the Republicans taking credit, yes, I think that's the case, but everyone's going to take credit for this bill, the political aspects, but they're not going to take credit for any kind of economic downturns from it.
Well, that's, I think, the point. I think this bill has a hidden potential for it backfiring on its makers. It sounds so nice, for example, to transfer the cost of doing business from individuals to business. And yet those businesses, as they anticipate the higher tax bill, they're going to take some action. And part of that will probably be passed on to the consumer in the form of higher prices. Some of it will be in the form of less in the way of dividends and profits. To people like those of us who hold mutual funds, will be affected by that too. And so as we may pay some of the price that we think we're transferring to business. And that's an unknown factor.
If you're a congressman, then do you want to take credit for having had a hand in this tax bill, or are you afraid of some of the consequences down the road?
Well, I think, again, politics is always kind of a short-run thing. And I think in the short run, I'd agree with John's analysis, which is the people who have accomplished something. They can say, we did something that no Congress has done. I think those people are going to benefit in the short run. We may see some adverse results over a number of years.
If I can quote one of your favorite economists, John Maynard Keynes, he says, in the long run, we're all dead. So the only thing we really have to focus on is the short run.
As the Dean of the College of Business, as somebody in the Department of Finance, people who study this tax bill as part of your job, so to speak, have you done anything? Has this tax bill, as it's proposed now, caused you to go out and make any changes in your portfolio? Has it make any?
I have not made any changes, nor do I anticipate any in the next several weeks or month or so, but once this thing settles and I can read it some more and think about it a little bit, it will probably make some difference on what I might invest in the next couple of years and what I might invest in.
Well, I think professionals generally who advise business are going to be looking very actively over the next few months at this bill, and I think there's going to be a lot of decisions made, perhaps not by those of us who have less of a portfolio to make changes in, but to those who we advise. I think there will be a significant amount of into the year tax transactions.
Your advice then to people who are reading these things in the paper about do this, do that now is sit tight, or?
I think that depends a lot on how much you have invested. I think it depends on an assessment of that portfolio. And if you have a complicated tax return, I think it's time to go in and see your account.
Go see your account. I knew you were going to say that. We're out of time today. Thanks to our panelists, Howard Hammer, Neil Palumbo, and John Rouse for the commentary today. I'm Larry Lough. Thank you for joining us.
If you have comments regarding this program, please address them to John Rouse, Box 149, Muncie, Indiana 47305. The producer for Public Affairs Roundtable is John Rouse. Associate producers are Cecil Bohannon and Bill Mosier. This program is a production of University Media Services, the Department of Political Science, and radio and television stations on the campus of Ball State University in Muncie, Indiana.